Intel looked healthy in 2021. 24% operating margins. A household name. 2 years later, that margin had collapsed to under 1%, and the stock had lost more than half its value. Here's the uncomfortable truth. The warning was sitting in a free filing anyone could read. Most investors just never opened it. So today I'm handing you the exact 30-minute checklist I used to size up any company using tools that cost nothing. No paid terminals. No insider access. Just 3 documents and a clock. And the third step is the one most investors get completely backwards. Start where most people finish. Not with the price. With the profit. Open sec.gov/EDGAR. It's free, it's the government's own database, and every public company files there. Type the ticker, pull the latest 10K, and jump to the income statement. Now don't read it top to bottom. Read it backwards. Start with operating margin, operating profit divided by revenue. That single number tells you how much of each dollar the business actually keeps. Here's the contrast that changed how I think. Apple keeps about 30 cents on every dollar of sales, a 30% operating margin on $383 billion in revenue. Microsoft keeps even more, 44% in fiscal 2024. That's the software moat, written in numbers. But a single year lies. Pull 3 years side by side. Are margins rising, flat, or quietly slipping? Intel's number whispered before it shouted. Rising margins mean pricing power. Falling margins mean trouble the headlines haven't caught yet. That's 10 minutes. And you already know more than most people who own the stock. But the income statement can be dressed up, which is why the next 10 minutes matter more. A company can look profitable and still be one bad quarter from disaster. The income statement shows the story. The balance sheet shows the survival odds. Same filing, scroll down. You're hunting 2 things. Cash and debt. First, the current ratio, current assets divided by current liabilities. Above 1 means the company can cover its short-term bills. Below 1 is a yellow flag worth a closer look. Second, debt against earnings. A useful gut check is total debt divided by operating profit. If it takes a company 8 or 10 years of profit just to clear its debt, that's a heavy load, especially when interest rates rise. Think back to 2008. The companies that vanished weren't always the least profitable. They were the most leveraged. When credit froze, debt didn't care how good last year's earnings looked. So here's a question for you, and I genuinely want your answer in the comments. When you buy a stock, which do you check first, the profits or the debt? Profits or debt? Tell me below. 20 minutes in, you know if the business makes money and whether it can survive a storm. Now for the part almost everyone rushes and gets wrong. Here's what nobody tells you. Most investors open a stock app and look at price first. That's exactly backwards. Price is meaningless until you know what you're buying. So spend 8 of your last 10 minutes on one question. Why can't a competitor destroy this company? That's the moat. And you can find it for free. Read the company's own 10K, where they're required to describe their risks and competition, and skim a few recent earnings call transcripts on their investor relations page. Look at Costco. Its operating margin is about 3%, a number that looks weak next to Apple. But that's not a weakness. It's the strategy. Costco keeps prices razor thin on purpose, and members renew at roughly 90% year after year. The moat isn't the margin. It's the loyalty. Low price is the moat. Only now, in your final 2 minutes, do you look at price. And you use one simple lens. The price-to-earnings ratio, next to the company's own history and its growth. A great business at an insane price is still a bad investment. Remember what I said at the start, Intel's collapse was hiding in a free filing. This is why the reading order matters. Business first. Survival second. Price last. That's your 30 minutes. And you didn't spend $1 to get there. Here's the transformation. You stop reacting to headlines and green arrows, and you start reading businesses like an owner. 30 minutes, 3 free documents, and 1 disciplined order. As Buffett put it, price is what you pay, value is what you get. The 30-minute checklist is just how you tell the two apart. This is educational content, not financial advice. Always do your own research before you buy anything. So, profits first, or debt first? Drop your answer in the comments, I read every one. And tomorrow, I'm breaking down the one balance sheet number that quietly predicted 3 of the last 5 corporate collapses. You won't want to miss it.